Which are the best yielding stocks, and should you have them in your pension? Well, there's a fundamental problem with this. Let me just first of all explain what yield is. It's the ones that are paying dividends, and it's worked out on the basis of if you put £100 or $100 into them, and let's say you got £10 or $10 back, then of course that would be a 10% yield. Okay, so it's straightforward. But this is the problem with yields. So let's look at some of the highest yielding stocks. For instance, Ithaca Energy, okay, rolling yield 21%. Wow, let's all plow into that. The only problem is it's down 26% over the past year. So you might say, well, okay, that's fine because the yield made up for the price fall. I'm not so convinced I'd want to look at it that way. Let's look at some others. Okay, if we look at Next Energy Solar Fund, these are UK companies, rolling yield 13%. There's a problem. It's down 27% over the last year. Well, Alpesh, last year, 1 year is just too little a time frame to look at. Well, actually, over the last 3 years, you're down 12%. You might say, yes, but if you include the yield, assuming it paid that much every year over the last 3 years, you'd be up. You're right, but don't forget the capital risk that you might be suffering, and the yield is never guaranteed to continue forward in any event. So there's quite a few examples of this. Aberdeen, the asset manager, down 23%. Yield 10%. Great yield, down 23% in the past year. Over the last 3 years, down 24%. Okay, the yield made up for it, and you're absolutely correct. The yield did, and it's worth looking at if they're a high yield stock, especially if, one, you can be sure they're going to continue paying those kinds of dividends, and you're planning to hold for a prolonged period of time, and it's a company which hopefully won't fall more than the yield would have compensated you for the time duration you're looking to hold it. So in other words, if you're like Warren Buffett looking to hold it forever, then a 9 or 10% per annum yield, guaranteed, let's say, which it isn't guaranteed because nothing's guaranteed with the stock market, but let's say it was close as guaranteed, you'd be more than happy with, because basically you're holding forever. Even if the company in the interim rises and falls, then that's all fine. I'll do more of these going forward. Oh, by the way, of course, you could always end up with what I discussed on the BBC several months ago, which is, say, HSBC, up 23% over the past year, yield of 9%, and up 100% over the last 3 years. I told them I focused not on the dividend yields, but on the stock price return. And I said previously, whenever it hits those lows which it had in the price, it's likely to double within 6 to 9 months, and that's what had happened. You can find that video on YouTube. You can find most of my videos, speaking both as an expert in the industry on investing as a hedge fund manager, but also as an author on investing, and you can download a free copy of this from alpeshpatel.com/links. I've written 18 odd books published by the Financial Times, Macmillan and the like, international bestsellers to boot as well. So if you want to have a look at those free resources, yes, I did say free, have a look at alpeshpatel.com/links. Do like, follow, subscribe for more information and insights. Oh, reach out to me. Just send me an email if you've got a specific question. This video was done because I'd been asked a question about dividend yields. So absolutely happy to do videos to questions that I'm asked. Sometimes I'm asked about why a certain fund manager or asset manager or IFA are performing poorly, and I'll research it and do a video for you. Thank you very much.